everyone. I'm Genna Garver. I'm a partner in Troutman Pepper's Funds Group, where my practice focuses on investment advisors and private funds. Thank you for listening to our podcast today on Regulation D Rule 506C to raise capital through general solicitations and advertising. Rule 506C was added under the Jobs Act and went live in 2016 to allow private placement issuers to use general solicitation to raise money from accredited investors. In 2019, the estimated amount of capital reported as being raised in offerings under Rule 506 was approximately 1.56 trillion, 66 billion of which was raised under 506C. Today's discussion is quite timely. The SEC adopted changes to expand the definition of an accredited investor just 2 days ago. The rule changes will not be effective until 60 days after publication in the Federal Register, but we do think the rule changes, coupled with our new remote working norm, might push 506C into the mainstream. For more on those rule changes, check out our website at troutman.com for our recent client advisories. Eric Chung and Greg Nowak have been kind enough to join today's discussion. Eric is a former corporate lawyer, I should say reformed corporate lawyer, and professional poker player who transitioned into running his own fund. Eric manages the Lighthaven Fund, a long-short equity hedge fund that, to his knowledge, might be the first of such to file a notice with the SEC to conduct a general solicitation under 506C. Greg Nowak is a partner in Troutman Pepper's Funds Group and provides advice on complex securities law matters, particularly on issues arising out of the Investment Company Act, the Advisors Act, federal and state securities laws and regulations, broker-dealer, FINRA, CFTC, and NFA regulatory matters, and corporate and M&A transactions. Greg has represented a broad range of investment funds in formation and offering, from funds that use the traditional broad investment charters and invest globally in virtually any financial asset to specialty niche funds. Welcome, both of you.
Thanks very much for having me, Genna.
And thank you for having me join you as well.
It's a pleasure having both of you here. A lot of naysayers I speak to associate general advertising with radio jingles and late night cable TV commercials that would attract folks addicted to shopping on QVC. But that probably tells you more about the people I hang out with than those that would take advantage of 506C. So Eric, what are the types of ads that you've been using in your capital raise, and who are you attracting from these ads?
Thanks for the question, Genna. I'd say that we are using 506C in a few ways. The first is that we tend to communicate a lot about the fund through video, and that's been pretty successful. I'm happy to elaborate on that later. The other way that we're taking advantage of 506C is we do have a fairly active social media campaign. So, we're on the standard social media platforms like LinkedIn, Facebook, Twitter, et cetera. And then the third thing that we're doing that probably doesn't count as advertising the way that people think about it, but we're just being, when we communicate with the press and the public generally, we're just able to talk freely about the fund and the performance of the fund.
And I've also noticed your website has quite a lot of information about the fund, its performance, and the terms of the offering. Is that correct?
Yeah, that's right. That's one of the things that I think is really interesting about 506C. I think, at least for me, originally I thought of 506C as the ability to post some advertising, whether it's an ad in a newspaper or a video. But actually, the thing that has been most beneficial is actually the ability to just talk very freely in our website or in other public forums about what we're doing, and especially our track record. The question is, who are you attracting from your ads? I would say that actually we haven't used the shotgun approach. So what we've done is we've targeted our ads right from the get-go. Because we primarily use social media, we we have the ability to target specific demographics. And we do this, like a lot of companies, in order to maximize the effectiveness of the ads. So we know ahead of time who we're targeting or who we think would be interested. Specifically, we are targeting people that we believe will be accredited investors and who might be open to investing in a hedge fund.
One of the benefits of 506C that I think gets lost in people focusing on the verification requirement is precisely what Eric was pointing out, that he could use social media without fear that he's tripped up the general solicitation prohibition under 506B. And whether you target it or not, unless you have a pre-existing relationship with the person you're sending that email to, you are outside of 506B if you send that blast email. Now, traditionally, the way people would purge that taint is they would wait 30 days after they sent out the email so that it becomes an old and cold communication. 30 days is a rule of thumb that practitioners have used for 40 years, but whether or not it's good or not has never really been challenged except in Ralston Purina, where the Supreme Court said it didn't work. So when you think about it, I like to think of 506C as essentially a leapfrogging the gatekeeper tool. It allows you to go directly to decision makers and not worry about the family office gatekeeper who says, I'm not going to talk to anybody who doesn't have $100 million in assets, for example. And so you can go right to the ultimate beneficiary who would say to his, family office manager, why didn't you show me this opportunity? Which is what we've seen with a lot of our crypto fund clients. The people who have the money, who are the beneficiaries of the money, want to invest in this stuff. They think it's neat and interesting, but they keep being pushed away because their managers, rightfully so, who they've chosen, are being more conservative and choosing more traditional asset classes. And so we've seen funds that use this technique to leapfrog the gatekeepers. They get right in front of that decision maker legally. Hard to do under a 506B.
Yeah, it's a really good point, Greg. I actually have experienced this. We're not doing this intentionally. We're not, intentionally trying to leapfrog gatekeepers, but because we are spreading the word about our fund through, email campaigns or websites, things like that. More than a few clients or people who are interested in the fund, have kind of a heart-to-heart discussion with their advisor about this. So the dynamic has definitely changed, and the power of these gatekeepers has lessened. I've seen that firsthand.
Yeah. So the other really important point, though, is you can't mix and match, and that is one of the dangers that we see with managers who want to have the benefits of doing a general solicitation, but then want to rely on the self-verification rule. It's kind of, once you've crossed the Rubicon and become a 506C, you've got to stay a 506C. Whereas if you're a 506B, you can always shift to a 506C as long as everybody who you take into the fund after that fact you verify.
Greg, can you please briefly set out the conditions for relying on 506C? Because it sounds almost too good to be true based on what Eric is telling us. Are there any specific conditions issuers should be aware of?
Well, as with everything in the federal securities laws, the regulator gives and the regulator takes away or puts limitations. So the question was, what are the requirements in order to invoke 506C? In order to do that, you need to understand where we were before the Jobs Act. So 506B was the general rule that was applicable for private placements. And what was defined as a private placement goes all the way back to 1953 in the SEC's Ralston Purina case that went all the way to the Supreme Court, that essentially says if a person does not have enough information to fend for himself, then they're entitled to the protections of the registration requirements of the Securities Act. So, and there was a lot of hair splitting as to what constitutes a general solicitation. Over the years, 506B evolved to be a very narrow rule that said if you spoke about your fund in public, if you had an open website, if you promoted your fund at a conference, if you sent out blast emails to people that you didn't have a relationship with, you were violating 506B. So when 506C came out, it removes all those restrictions. And the only requirements that you have for 506B, there are two. One, you have to file a Form D and request the status. And two, you need to verify before you accept the money that, in fact, the person is an accredited investor. Under 506B, you could accept the verification or attestation of the investor that they were accredited. Now you have to go one more step. And that became the biggest stumbling block to a broad acceptance of 506C, namely, people were afraid of sharing their very personal information about their income and tax returns. Now, if you parse that a little bit, there's a gaping hole or question, which is, well, I just promised in a 506B offering that I'm accredited. I've represented that, and people are relying on that representation. Well, what's so hard about proving it? And I think that is one of the sort of fundamental questions, and I'd love to hear Eric's take on the clients and investors that he has spoken to and whether or not they have a problem verifying their accredited investor status.
Yeah, thanks. Good question, Greg. Yeah, so far, and this is admittedly, we haven't run, hundreds of people through the process, but so far, we haven't lost any clients because of the heightened accredited investor verification process. I will say though that most people they do ask questions about it, and they're used to self-certifying. So it's something that people are still getting used to. And there's no question that it definitely has added some friction to the onboarding process.
The SEC's rule changes this week were in part to address the verification requirements' potential impediment to the use of Rule 506C. The updated rule will provide additional avenues, such as obtaining licensing information about registered representatives and investment advisor representatives, as they say, easily through using FINRA's broker check or the SEC's investment advisor public disclosure database. Eric, obviously these rules are not in effect yet, and we still need to live within the confines of the current definition of accredited investor. How have you been operationalizing the accredited investor verification requirement?
Yeah, I mean, we've been doing our very best to stay within the SEC safe harbor. So I know that the rule, tries not to be super prescriptive, but just as a former lawyer, I'm not super comfortable kind of taking big risks on this. So most commonly, we do ask for third-party verification. So I feel better when an accountant, the investor's accountant sends me a letter verifying accredited investor status, or an investment advisor. If we have to, we will accept income tax returns or other proof from investors directly. But truthfully, this does make me nervous. I just, for whatever reason, we prefer a third party validate. Interestingly, there are, not infrequently, people have expressed reluctance asking their accountant for this information for whatever reason. Like sometimes it's just as simple as they don't want to be charged, by their accountant for this. So anyway, to answer your question, we try really hard to stay within the bounds of the safe harbor, and usually we ask for third-party verification.
And is the third party that's providing that verification a consultant that specializes in this particular area, or is it some other service provider associated with the investment?
Historically, we've just asked our prospective investors to go to their accountant or their investment advisor.
Greg, can you please explain the SEC's guidance in this area? Like, what would be enough? And also, if you have any solutions clients can use to get help with this verification process.
Sure. First of all, remember that the verification only comes at point of sale. So when you're ready to accept the investment, that's when you need the verification, not before you solicit them. That's the whole point of being able to solicit generally. And then secondly, once you're already in that conversation with the investor, you need to ask them to verify their status. Now, how do you do that? One way is you get copies of their 2 most recent years tax returns or W-2s, or if they're a partnership K-1. But the interesting thing is you don't have to get the whole return. Most high net worth individuals, for example, will have tax returns that are 50, 60, 100 pages long. And you really don't need that to have a reasonable verification. You just need the first 2 pages with the signature of the taxpayer showing that their adjusted gross income is above the income level that's specified in the rule, $300,000 on a joint return. Theoretically, you could mask everything else on that page as long as they say this is a certified copy with everything else redacted. So, and even your social security numbers of your kids and everything else, because you'll need the number, obviously, because you're opening up an account and you have all of the AML issues to worry about. But you won't have to get the whole return. So that's the first point. The second point is you can get an accountant, a lawyer, another investment advisor, a broker to give you a verification letter. Now, as Eric said, one of the issues with asking a professional like a lawyer or an accountant is they're going to charge you for it potentially, unless you have a very deep relationship with that person and they also happen to know your status. A broker is probably going to try to sell you to stay with them, as will an investment advisor if you ask them for a letter verifying your status. So while people can use those as verifying sources, it tends to create a competitive environment. Now, the other thing that we've seen is services that have come up that act as repositories of the data and give you a verification letter that says Mr. Smith is in fact a accredited investor. And these are online services, and for relatively modest fees, we've seen them provide this verification for accredited investors. It's almost like a FICO score. They give you an accredited investor score, and then they verify, retain the records, and you simply have to retain the communication from the firm. They have been extremely effective for those who are trying to use the general solicitation rule. The other thing to keep in mind is this is like a first step gate, right? But if your fund has a performance allocation or a carried interest or back end profit share, and the advisor is a registered advisor, you're going to have to meet higher standards of accreditation anyway, the so-called qualified client rule. So certainly in fund world, you need to keep that in mind. Now, those you can use as self-verification, but if someone gives you $1 million in order to be considered a qualified client in your fund so that you could charge them a performance allocation, the highly likelihood is that they have met the accredited investor status. And, that's somewhat of a brute force approach. To be honest, I've never seen anybody use the net worth approach on the verification because, as laid out in the rule, getting credit reports and income statements and asset statements, that's way too intrusive, and I've never seen anybody use that approach.
I would just add here too that for offerings that include non-US persons who are here in the US, the use of a third-party service that specializes in this verification can be quite useful because often their documents are not quite like what we've seen for US persons who are interested in investing. So moving on here. So skydiving isn't for everyone. Eric, you've been kind enough to share with us that certain aspects of 506C make you uneasy. Is this option really for everyone?
In my opinion, it's definitely not for everyone. It definitely requires a commitment to marketing. That's what a general solicitation allows. And marketing and advertising, in my opinion, is very much an art. So you also have to be like super patient and stick with it. The other thing I would say is that marketing and advertising for hedge funds, so the general public, until recently, it wasn't something that hedge funds did. So as far as I can tell, there aren't a lot of people who have successfully figured this out. We certainly don't feel like we've solved this problem, and there aren't that many people who can advise on how to do it effectively. So I think it's a change in thinking. Previously, essentially hedge funds were only selling. Now, hedge funds also have to be good at marketing, which is a prelude to selling.
So historically, part of the lure of a hedge fund was its exclusiveness. And I'm curious if you've ever been snubbed in the industry because you've chosen this more, potentially more inclusive approach to capital raising.
That's a great question. In a former life, I was in the fund space, so I have an institutional mindset, and I was worried about this. I also remember that in the past, there have been other financial firms that have done, creative things, whether it be E-Trade or Charles Schwab, and those firms, when they were doing innovative things, were snubbed. And I would say, however, that hasn't been my experience. And in fact, when institutional investors are looking at our fund, especially given COVID-19, they've actually welcomed the fact that we have a lot more information on our website and our emails. What I think it does for the fund, at least in 2020 during COVID-19, is it provides much more transparency into what the fund's doing and its performance. And that has been welcomed by both individual accredited investors and institutional investors.
If I could just add to that, one of the great anachronisms of the 2020s is the fact that we're still working with the concept of a private offering in the information age. The concept of private offerings came out in the 1930s when, in fact, you could embargo information by simply preventing people from sending out a PPM or sending out a tear sheet or other information by mail or using the radio or whatever. Today, information is ubiquitous, and if you deny access to it, if you say to investors, you need to become on my platform first before you can access my information, they resent that because everybody is used to just going on the internet and finding whatever information they want. So it seems to me that the idea of embargoing information to protect investors is probably an idea whose time has passed. And maybe what we should be focusing more on is how do we take the transparency that Eric was talking about and use that as to our advantage, to the advantage of investors, and put more information available. If you're going to make more information available, that will be deemed to be a general solicitation. And by force, you will have to do a 506C. So, that's the tension, balancing availability of information versus, needing to comply with the law.
Greg, are there restrictions on who can use this exemption? Is it really for everyone?
Well, certainly it was designed for the operating company, not a fund, who wanted to raise capital because they didn't have to worry about qualified client or all those other rules. It is not available if the company that you're working for is a bad actor. And the bad actor rules are defined in Rule 506D that lays out a whole category of people who have been convicted felons or have defrauded the post office or have been banned by a foreign securities regulator. So if you're involved with or running a company or a major investor in a company and you have one of these disqualifying attributes, then no, it will not be for everybody. My biggest fear is that you have people who think they're doing a 506B, a private offering, and then either intentionally or inadvertently cross the line into general solicitation. And so if you're risk averse and you want to do it the right way and provide transparency, the only way to do that in a private offering is a 506C.
And I would add to that, those bad actor rules for anyone considering using this exemption, really take a look, because the categories of people that could be deemed bad actors are quite broad and include people who are not necessarily employed by the issuer, but also those that might be participating in the offering, including third-party marketers who might be participating to help funds raise money in particular. Eric, what has been the most surprising result of your general solicitation journey?
Jen, I'm going to answer that question, but I was actually hoping I could take the opportunity to comment on something that Greg just said. I think it's a really nice segue. It's an important point. Greg, I think earlier you mentioned that originally 506C was really meant for operating companies and not necessarily for funds. I wanted to actually make a comment about that. In my opinion, there's a bit of a disconnect between what 506C permits and one of the restrictions or one of the requirements of the Investment Company Act. So a general solicitation is great for reaching a gazillion people, including accredited investors. But ironically, under the Investment Company Act, if you accept even one accredited investor, your fund's a 3C1 fund, which limits you to 100 investors. So, it would have been amazing if 506C was an effective tool for massive scaling, like what you see with a lot of Silicon Valley tech companies, fintech companies. But candidly, as my fund, we get closer to the 100 investor limit, the more I factor this into my ROI calculation. And I'd actually be much more willing to invest in advertising and marketing if that 100 investor limit was a lot higher. All that said, I do think that 506C gives new funds a tool that somewhat levels the playing field. And the reason I say that is that I think most new funds would love to max out all the slots on a 3C1 fund. That would be a really nice problem to have.
What we've seen are people who create parallel 3C1 and 3C7 funds, and they generally solicit both of them on the same offering document. So you'll see a PPM that says the ABC 3C1 fund and the ABC 3C7 fund, right? And statutorily, the SEC is precluded from integrating those two as long as you don't do a master feeder structure. So you create that, and then as your investors come in, if they're just accredited and qualified, they go to the 3C1, and if they're qualified purchasers, they go to the 3C7. And so you preserve slots that way. The other issue with the disconnect that you're pointing out is a really important one. The tax laws, which we haven't talked about at all, impose a limitation if you have more than 100 investors. And so we would need a more comprehensive review of private funds and change by Congress to change not only the securities laws, but also the tax laws. So I think we're going to have to be stuck working through those limitations for a while.
So Eric, what has been the most surprising result of your general solicitation journey?
Yeah, thanks for the question, Genna. Originally, I thought that if I posted an ad or did this general solicitation, we would have immediate results because our fund has quite good performance. But the reality is that based on the metrics that we were seeing, that it wasn't happening in that way. Our ads didn't immediately cause this massive rush of clients immediately. The surprising outcome, however, was that the value of doing a 506C wasn't really in the immediate responses to the advertising. I've come to actually believe that the value in advertising is much longer term. It really helped us to spread the word about the fund in some very surprising ways. Specifically, we were able to freely talk about the performance of the fund. People were following our performance and our story on social media. They were watching our videos. Whenever we did something that was newsworthy, as an example, in the first quarter of 2020, our fund was up 18% net of fees as a result of us hedging the fund against the COVID-19 market crash. And we posted a video about this, and that video became a trending video on LinkedIn. And that created a lot of awareness about the fund. As I mentioned, people were just constantly, watching our emails and our track record. So being able to talk freely about the fund, to me, meant that people were constantly thinking about us. More than a few times, people that we didn't know, we didn't even realize that they were interested in the fund. They would ping us and say, hey, we'd like to put money into the fund. And it was a bit of a surprise to me. The realization was that the general solicitation gave prospective investors a lot more information than they were used to, so that these prospects could essentially follow the fund and commit to invest on their own timetable whenever they were comfortable. So in summary, I would say that the most surprising outcome was that this really turbocharged and made our selling process much more easy and scalable.
Eric, one of the best outcomes for you using 506C is that you are available to speak with us today and share your story, and we are greatly appreciative of that. Eric and Greg, thank you both for today's discussion, and to our audience, thank you for joining us.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.